Okay.
Good afternoon, Uncle Fu. Hi, welcome everybody. Say hi if you're in the stream, and so that we know you're here, and we can say hi to you as well. If you're first time here, you can remember to click on the StreamYard link so that you can enable your profile to be viewed by StreamYard, and we can see who you are when you do ask questions or when you do have comments here. Hi, Jason. Hello.
Right, hi Jason. Hi Uncle Fu. Right, hi Kai.
Hi. Right, Terence, how was your week for you?
Not too bad. Hectic week. Having a terrible Sunday actually, trying to fix something up at home, and obviously realizing I'm not too handy.
Right. The trade is the week itself was pretty quiet for me because I was looking at the first 15 to half an hour every day. It was something like there's nothing much for me to trade much. I think I only took about 1 or 2 trades for the entire week and was more quiet here. Right.
Yeah, similar. I did take the opportunity to issue out some trades over the week, but pretty much like trading because even though we have a sell-off, but the sell-off didn't produce much signals to actually really go long because a lot of the stocks they are selling off are already severely overvalued counters. So it will still be too early to jump into them.
I see. Yeah. All right, we do have a first-time viewer here. So we have a Facebook user who has not enabled the StreamYard link to view your profile. So this is what we'll see from the back-end view here for myself as well as Terence if you have not enabled the link here. So look out for the streamyard.com/Facebook to enable your profile to be viewed by StreamYard so that we can see how does your comment look like. So if let's say if you enable it, it will actually look like this, like Richard here. Hi, Richard here. And hello to Ikai, hello to Josephine, Fang-Xing, as well as to Gendry here. I will just give it a while more while we wait for some of our viewers to stream me here, and we will start in a while. Right, so Terence, so we will be meeting with a quick 5 minutes from your side, and then we'll go into the company I have here. I'm pretty excited because this is actually back to our normal format because for the month of October, we did something like a dedication for our viewers here, and we allowed them to actually have a poll whereby they get to choose what companies they can they like us to do. And it appears that for the whole month of October, we didn't issue any recommendations for trades, if I'm not wrong, right?
Yes.
Right.
I think our Facebook user happens to be one of our grads, actually, Simon. Simon, I think we need you to click on streamyard.com/Facebook and then approve it so that the next time you type a comment, we'll be able to see that it's you, Simon. Okay. All right, now, so we'll just let a couple more minutes roll for people to stream in, and we'll start officially at, right now, 4:05.
Right, rest slow, Terence. Yeah, back to you, Terence.
Right now, so thank you very much. Welcome again once for joining us over the weekend. Today, I'm not blocked out, so I'll be able to do my market sharing before Jeremy takes things off. Right now, so once again, do help us to get more reach out for these weekend segments that we are dedicating to educate all of you as well as to bring great stocks to all of you in the meantime as well. So if you can, do click on the small little share button at the bottom of the video and just couple out with a stock sharing. Okay, just leave something in the post header over there so your friends probably know what the video is about. Okay, all right, and have them join us as well. Okay, have them join us as well. All right, now, so let me get my screen up. Okay, let's get go. Now, so I'm just gonna go with the market outlook over here. So let me first pull the charts out a little bit more. Okay, so I'm gonna pull it out to a one year daily chart. So as you can see, obviously we have our bottom over here sometime in March. And I basically cycled the idea where you can actually see back then we had this. Okay, that means we had the indicators. Give me a minute while I get my. Okay, all right, now, so we had the RSI indicator went from the top, which is overbought, all the way down to oversold levels. And of course, you know, once it hit the oversold levels, then we had it cycle all the way back up. Oh, man. Okay, there we go. Okay, cycle all the way back up over here to the overbought levels. Okay, and it never cycled back down as yet. Okay, so this time it seems that we might actually get there. Okay, now, so you can see this time, if all of you are seeing what the RSI is doing, it seems to kind of mimic what we have in March over here, right? There's a lot of resemblance that is going on right now, okay, in terms of how it's moving and in terms of what it is showing to most people as well. So I just want to circle it and show all of you what I'm trying to talk about. Oops. So I'm trying to talk about this period over here where we had a sell-off in March, right? Okay, so we had the RSI actually circling from the top all the way back to the bottom, right? It's a little bit quicker, it's a little bit more severe, but what you're seeing right now, it's very, very similar movements. Okay, why do I say it's similar? Because we had a peak over here, right? And you know, the market before the sell-off in March, it also had a peak over here. Yeah, all right. Now, so as it continues to drive higher, which is what we're seeing over here, it continues to try and reach new high. We have a divergence in the strength indicator, all right? Now, and then of course, when the selling comes in over here, it starts to sell off. And usually for the RSI, the struggle happens at 50, okay? Which means when the RSI is at 50, all right, we have the struggle of whether the uptrend is going to continue or, you know, it gets broken over here. And obviously right now with the RSI sitting at about 30 plus levels, all right, 36 levels over here, it seems like the sell-off has taken over, at least for the meantime. The sell-off has taken over, and now it has led us to wait for it to cycle all the way to the bottom. Okay, now, when is it going to get to a bottom? Nobody knows. Okay, now, of course, some of you will probably say, hey, Terence, but the indicator below the stochastic seems to already be oversold. Yes, but you know, as you can see over here, the stochastics is much more choppy, which means when it gets oversold, it can actually stay down there for quite a bit of time. Yeah, okay, quite a bit of time over here. Now, so it can continue to, you know, cycle below here before it starts bumping back up. Okay, now what's also more a little bit concerning is, you know, for a while now, okay, you actually start to see that the MACD, all right, which is also a strength indicator, the secondary trend, which is the second lowest strength trend over here, started to turn negative. Okay, and the histograms are actually starting to gather pace. Okay, that means it's getting bigger and bigger and bigger. Right now, so as you can see over here, as it gets bigger and bigger, right? The last time around, okay, we have the sell-off continuing over here. Yeah, okay, now if it starts to dissipate, all right, that's when you start to get a sideways movement, or you might actually get a reversal over here. Yeah. All right, now, so next concerning part over here is if you pull it out to a longer time frame, okay, that means if I pull it out to a weekly chart right now, okay, this is also the first time that you see on a weekly chart, right? The histogram has finally turned negative. Okay, because since the recovery in March, right, okay, we had the histogram staying on the positive zone for a very, very, very long time. Okay, this is the first time where the line is cut below and it's caused the histogram to turn red. Okay, and of course, you can see the RSI coming back down. The stochastics have just started as well. So, you know, the sell-off could really just be taking place. It may be, you know, some signs ahead of elections, which is next week. I have no idea. But right now, I do foresee that the market will hold. Okay, it will hold at least until the elections are over, which is, you know, only a couple of days away from us. And we have kind of like a double jeopardy right now. We have a double jeopardy because we have concerns with the elections and what happens after it's over. And the next immediate concern is earnings season is not over, right? Of course, the heavy ones is over because major of the tech companies have already announced this week, but there are still a lot more companies to come. Okay, so it's not effectively over. So if you get some fear after elections coming in, for example, let's say the Democrats found a way to win it, all right, and then they start to seed out news that, you know, Powell may actually be elevated from his seat, Okay, that will cause some concerns over the cheap money as well as stimulus as well as low interest rate environments. So that is going to cause uncertainty. And if you couple with a few major company announcing terrible earnings, right, it may cause a shake-off in the market. Yeah. Okay, now, so over here, though, I do see that we are now in this zone again. As you can see, it was struggling over here. All right, I think this Friday, Thursday, Wednesday, Tuesday, Monday. All right, so for Monday, Tuesday, it was still struggling on the support level of this box. Okay, those of you that joined us a few weeks before, you realize I'm saying like, this stocks tend to move from ranges to ranges. So we had this range which was broken over here, all right, and then it was struggling on Monday, Tuesday, fighting around with it. And once it broke on Wednesday, all right, you can start to see that right now we're just trading in this zone. So this zone now has a low of about 3,200 and a high of about 3,004. So we are once again back into the 3,002, 3,004 levels. So right now we can still see a sell-off, and the sell-off should challenge the 3,200 levels before we see any bounces over here. All right, which is what it did on Friday, if you realize. Okay, the low of Friday was 3233. Yeah, all right. The low of Friday was 3233 before it started to receive some kind of a bounce over here and close only 40 points down. I think the most severe of the day was around 60 over points. Yeah, okay, before it recovered a little bit before closing. Yeah, all right. Now, so let's bring it to a lower time frame and just observe what happens before close. Right now, as we can see, we had the last two bars where we have the recoveries over here. And just to highlight the case of one question that I received over here, which is if you are trading the SPY, okay, if you are trading the SPY options, okay, because some of you may be selling call options on SPY right now, okay, if you are selling call options on SPY, and if you have a strike on the final day that it's on the brink of borderline, if you start to see these two kind of candles in the last half an hour, right, no matter whether you're out of the money or not, you should immediately close the position before the market closes. Okay, why? Why? Simply because, okay, let me do some quick education and I'll pass it over to Jeremy. Okay, why? Simply because
you will realize that this is another added value that Terence came out of the blue again.
Yeah, right now. Right. So why you need to close it, right? It's very simple, because a lot of you think that when the markets close, that's when the options expire, but you're wrong, right? Because the holders of the option have a window. They have a window of, I think, 1 hour actually. They have a window of about 1 hour after the market close to actually hit what they call the exercise button. So they can't close their option, but they can always hit the exercise button. Okay, now, and as you can see, right, the last half an hour, we had that trend that was kind of doing the bounce up. So this will lead to a lot of short sellers having to cover their positions. So what happens is you start to see in the next two 15-minute candles over here, it continues to go up some more. Yeah, okay, it continues to go up some more, and then it hits a high of like 330, right? 330. Can you imagine that? Because it was it was a low of 322, right? It was trading at 322 into the final half an hour, and then it went from 322, right, to a high of 330 over here. That is what I meant by the short coverings. That means people who have taken short positions throughout the day, right, they got spooked by the final hour, plus the fact that they don't want to hold it over the weekend, right? So this panic covering over here may lead them to cover, right? And because of the lack of volume since market is closing, they are trading after hours, right? So, this slight spike in volume will actually cause the SPY stock price itself to jump. Yeah, okay, now, so unfortunately, if it crosses over your sell call strike, right, you will actually get exercised on it. Yeah, okay, you will actually get exercised. So now you are left with a difficult situation, because you exercise, which means you are on a short SPY position. Okay, because a sell call will lead to a short SPY position. Yeah, okay, and you are at the mercy of the market right now. Because if Monday it were to gap up or it were to move up, all right, then you'll be looking at larger than expected losses. But if it comes back down, that means something bad happens over the weekend, and then we have a gap down on Monday, then count your blessings, because you'll end up with a bigger than expected profit. Okay, but as an option seller, this is not the situation you want, because you want to be in absolute control. You don't want to leave things to chances. You don't want to leave things to luck. Yeah, okay, so if you are doing something on a very volatile stock, and you're doing something like on the SPY, be it Facebook, be it Amazon, be it any of the hot stocks right now, if you're selling options and coming to the final day, if your sell strikes are too close for comfort, just pay the premiums and get them close. Okay, pay the premiums and get them close, even if it means taking a smaller profit. Yeah, okay, even if it means taking a smaller profit, just get them close, because it'll give you a lot of peace of mind. Because if you still like the trade, you can always start placing the next week's expiry. Yeah, a lot of new option sellers, they don't think like that. Oh, Terence, if I close this trade, I made less. Yeah, but if you still think that you have that trade on, then why don't you just close it and then sell next week if you still like it? It's a matter of continuing that. Yeah, okay, don't be one-dimensional. You need to start looking at this, because when you own a stock, it is a continuous kind of trade, whereby there's no expiry date. But when you trade options are considered, you're trading in chapters now, chapters of a book. All right, every option has an expiry date. So every expiry date is like the closing of a chapter. But closing that chapter doesn't stop you from opening the next chapter. You have to remember that. Yeah, okay, now, so that will be my market take over here, as well as small little segment of some questions that I received that I felt that it was important to actually put it out for both publics as well as people who are joining us over here. All right, Jeremy, back to you. Let's get to our stock for today.
All right, thank you, Terence. Right, so I think in a nutshell, what Terence is actually saying is actually a different paraphrase in terms of what he's been telling myself since 4 years ago when I started my own journey under him. It is to be careful and to always remain in control. And even in this case, right, if you, let's say, for example, you're making less, at least you're still in control. So actually, in this case, so what we're doing is that you are paying to close the position so that you still have the control here. All right, so for our viewers here, if let's say for you like what we're seeing so far, just remember to do the like as well as to do the share so that your friends and your family members can actually also enjoy what you're saying and what you're learning as well. So let me just start my own sharing here. So before I start the session here, I need to emphasize here that our sharing today is purely for educational purpose. So any stocks or any counters that we mentioned today, we might have positions on them, depending on time they look at them, as well as the fact that if you would like to do any trades or any positions on them, or to manage any positions that you have on them, remember to do your own due diligence and to seek out financial advice if you're not sure what you're doing as well. All right. So the company that we're actually doing today is actually the company called MTC. It should not be too unfamiliar for some of our community members, because this is actually one of the companies that actually fulfill our criteria, right? So here at IMP here, we do have a criteria for stocks that we actually look at, and this is one of the companies that we look at. So if you'd like to understand like what is the kind of companies we actually look out for, you can actually consider to join our program, and you'll be able to have access to our list of stocks here. So for MTC wise, right, so sometime in March this year, the low of the company was actually about $15.75, and then it hit a peak in October at about $52.50. So it's been like an uphill here, and we see that since October when it hit the peak, it's been on downhill, going down as well. It's actually about $43.52 since we last spoke. Actually, this is actually the last Friday's closing price. Now, what does MTC do? MTC is actually an American holdings company that operates home construction, mortgage insurance, as well as titles company. So just think of them as a whole construction company all in one. Okay, they are focused on single family as well as residential communities in the Richmond American home brands in Arizona, California, Colorado, Florida, Virginia, Nevada, Utah, as well as Washington. And they construct homes for first time as well as home move-up home buyers. Most of the company revenue is actually from home construction in some of these cities as well. Now, I must say, in terms of how the company makes this money and what the company does, right, it's not something that we will be very familiar in here in this part of Asia, because here in this part of Asia, we don't really have a lot of companies that does this. So let's just try and pick up some of the red flags in the company's numbers, the company statement, to see whether there's anything we need to be aware of. All right, here. All right, so as we start, right, these numbers are all taken from Morningstar from this morning. So the sharing itself, right, the preparation is done in 15 minutes. I mean, the train of thought is done in 15 minutes time, but the slides, of course, will take a bit longer because we need to prepare it as well. So in 15 minutes time, we came to the conclusion that, hey, this is the stock that we're going to be looking at. And we also had a conclusion with Terence yesterday as I was actually doing my own shopping as well. Now, let's go into here, right? So we're looking at the price book, price cash flow as price sales numbers, as well as price earning numbers, right? There's really nothing to be raving about. The numbers are all very ordinary here. They are very in line with what you typically see in a healthy company here. So no reflex for now. And if you're looking at the growth in terms of the 3-year annualized here, that means, for example, in a 4 years time frame, 1 to 2, 2 to 3, 3 to 4, in 3 years annualized numbers, right, the income for the company has been growing as well. So far, so good. The company seems to be very healthy here. Nothing to be complaining about here. And as far as I'm concerned here, the company has a pretty healthy. Oh, just a second here. Pretty healthy. Just some technical difficulty. Okay, pretty healthy quick ratio as well as current ratio, which actually depicts their current liability, and they are actually able to service their current liability as well. But for the debt to equity ratio at 0.61, it's a little bit high for my own comfort here. Personally, I would prefer a company with a lower debt to equity ratio. But this is the first of the red flags we identify here. So let's just keep it there and we see whether this is something that is a cause for concern in the overall picture here. And moving along, we see that in terms of the company-wise for the current climate, it's actually profitable, right? So the return asset, return equity, return invested capital, as well as the net margin is still positive. So far so good. And if we dive deeper into the net income numbers, we see that since 2017, right, net income numbers has been growing, and also for the diluted earnings per share, it's also been growing as well. So this is very good here because we don't want a case whereby net income is growing, but earnings per share is actually not growing, because this will mean that the shareholders are being diluted as well. All right, so we are ultimately going to be shareholders in a way. So we want to make sure that we don't want a case whereby the net income goes up, but we see the net income going up, but we don't have a way to participate as well. All right. And in terms of assets and equity here, we see that, yes, assets are growing. Equity is also growing. This is a good sign here. But earlier, we did mention that the debt to equity ratio is actually growing. It's also pretty high. So I did the quick numbers in terms of the liabilities as well as debt in terms of growing here. Since 2019, as well as until the second quarter for 2020, we see that the total assets has grown by 0.17. We're looking at billion numbers. And equity as well has grown by 0.09, whereas for liabilities and debts, we see total numbers has grown by about 0.11. So it's a little bit higher in terms of the liabilities and debt has outgrown the equity here in these current 2 quarters. But if, let's say, for example, this trend doesn't continue and doesn't go faster, meaning you say the liabilities and debt grow faster than the equity, this is not a cause for concern. We just want to monitor the trend to make sure that this does not grow into something more unhealthy in the long run. So at this moment, this is not, well, it's not something I like, but this is not going to be something I'm very too concerned about. All right. And in terms of the cash flow statement here, we see that, hey, 2017 it has a positive free cash flow, where 2018 is the negative, and in 2019 it turned positive as well. I think in terms of the numbers here for free cash flow, right, this is not something I'd be comfortable with because it's not consistently positive, or it's not something that I see that is consistently growing up. So I would say that I don't really like the free cash flow portion of this company here. But in the whole big grand picture here, we just going to list this as one of the red flag here to see whether this is going to be one of those companies that has too much red flags, or has one of the red flags which is going to be telling us that, hey, we're going to avoid this altogether here. Okay, so for the viewers who are not familiar with our style here, in 15 minutes, we're going to look through all the company statements and we see whether there's any red flags that immediately tells us that, hey, step away, or we accumulate enough red flags to tell you that, okay, this company is something that you should not be looking at this moment. You might want to revisit it again. So this is what we're doing here. All right, so far we have second red flag here, which is the inconsistent free cash flow here. All right. Now we're looking at the numbers in terms of the value at the previous price X ratios. We're looking at price earnings, price cash flow as price book here. So here we are comparing against the current numbers against the 5-year average and the current numbers against the index here. Now, at various stages, we see that the current numbers for, let's say, price sales, right, is actually better than the index. Or in terms of the earnings, we see that it's actually better than 5-year average and the index. Or the price cash flow, this is actually better than the 5-year average. Okay, not better than the index itself. For the price book, this is actually better than the index. and the price to forward earnings, this is the one that we seldom look at. It is actually better than its 5-year average. Now, we're seeing that at least in different angles against its 5-year average, against the current index, this company seems to offer a little bit of value at against the index or against its historical self. So we're not seeing the case whereby the company is totally too expensive across board against either its historical self or against the current index. So this is a good sign here. This could be a very good value play that we can look at. Now we're going to examine the PEG ratio later to see whether this is something we can look at, right? So for this company, this is a company that we will really like for our community members here, IMP community members here. We like consistent dividend trend, right? So this company is one that I will really like to look at in the long run here, right? So here, what we do is, hey, we see all these positive numbers. Let's use the assisted screening function here. So this assisted screening that we're using is actually from Simply Wall Street here. So these are the views from Simply Wall Street. This is not our views here. We're just using them to actually help us here in a 15 minutes process here, right? So you need to be able to do so if you want to adopt a faster, efficient approach to review your companies here. Now, in the executive summary for MDC Holdings, right, as of this morning here, all right, you see that there are actually two different Bs that they have filed out, which is that is not well covered by the operating cash flow, and there's a significant insider selling over the past 3 months. And of course, they have all the 4 different rewards that they think that this is a company they like here. Okay, so let's examine it further to see what they are saying here. Now, under Simply Wall Street, they have this parameter, which is one that they say, oh, based on their calculation, this is a fair value that they believe to be. Okay, I don't pay too much attention to this because I believe that this is a way of how they calculate, and there will be a certain level of biasness here because of how it is calculated. And when numbers change, let's say for example, when new earnings numbers come out, I've seen these numbers change drastically. Personally, I've seen that. So I will always take these numbers as a bit of a pinch of salt here. But for our viewers here, you may like to use this as a reference just to have a feel of how the company's price is in terms of how the company, Simply Wall Street, is looking at it. Okay, so they view that the fair value is at USD $174, whereas it's now trading at $43. Okay, and all right, the PEG ratios. PEG ratio is actually less than 1. In fact, it's actually 0.3. So PEG ratios, for those of you who are not familiar with that, is actually a way for us to measure whether the future earnings for a company, right, is actually priced adequately. If it's less than 1, right, it will mean that there's a certain level of value to be considered that you can exploit in this company's numbers. All right. So PEG ratio, right, if in a certain sense it can be manipulated. If let's say for example this company holds a lot of cash, so you shouldn't only look at one parameter. You shouldn't only look at PEG ratio. You should look at it across board to see whether there's a lot of things that the company has a lot of red flags, other red flags here. But in terms of just having the PEG ratio and doing the other financial statements, the financial numbers here, I think this is one that we should really be considering to see whether you can structure a trade here. And for the debt issues that is highlighted here, okay, now you see that under the blue line, the blue line is actually the equity portion since 2014 to 2020. And they have a forecast as well based on trajectory. The red line is the debt, and this is also their forecast here. Now, there are comments here. MPC's debt to equity ratio of 57.6% is considered high. This is my view as well. Reducing debt, MPC's debt to equity ratio has reduced from 17.9% to 57.6% over the past 5 years. Yes, it's improving. This is a good sign here. Right, debt coverage. MPC's debt is not well covered by operating cash flow. Okay, no, not good. But interest coverage, MPC earns more interest than it pays, so the coverage of interest payment is not a concern. So if they are actually able to pay all the interest somehow, then it's not a concern. See, the thing is that a company will always be in debt. A company that is fiscally responsible, this is again, this counterintuitive for a personal finance here because of how we look at things. A company that's fiscally responsible will always have debt, because this is how they can leverage faster, and this is how they can grow faster. The concept of using other people's money in the entity world, in the corporate world, is always been prevalent, and is always one that is explored a lot in the finance world. And you will always have to have debt to be able to take advantage of the efficiency ratios to improve your company's capability to expand fast. Now, as long as they can pay off the liabilities in the debt, there's no issue. And in this case, MDC seems to be able to do that. All right. And the insider trader selling that we're looking at, insider selling. Okay, pay attention here. Okay. I did mention the case of insider selling in the last 2 sessions in the October special. All right. So in the last 1 year, we see 1.3 million insider selling, 300,000 insider selling, about 350,000 insider selling. So let's say we sum this up, 1.3, 300, 300. So this is about 1, 2, 3, close to 2 million, worth of insider selling. Okay, this seems a lot. Okay, this seems a lot. Now let's put it into perspective. Top shareholders, BlackRock, 399 million. Okay, let's look at the 10th. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. BNY. BNY has 47 million. So what does 2 million look like? It looks like peanuts to me, to quote our Singapore politician here. All right, so I do think the 2 million insider worth selling is something that we should be looking at. And personally, I think that the insider selling is one that the Simply Wall Street parameter did flag up because they need to, and it's part of their screening process. But I don't think that this is something that we should be too concerned about, because this really just a ripple in the entire pond or the sea here, right? So now we look at the income stream fundamental numbers for MDC here. You see that the book value per share of the company is actually about $28 here. Yeah. All right. So it's $43, trading at $43 now per share. So we're not really going to be able to trade anything really at the book value, unfortunately. But this is a company that appears to be a very solid blue chip with a good dividend track record, with some red flags because of these debt issues, but they seem to have it covered. And now there are a few things that I am concerned about in terms of the macro issues here. Now, number one is that, hey, at this juncture, we have the binary event, the US presidential elections. Number two, whoever that is going to get into the White House again will have to handle the inflation issues that is caused by the current regime. Face it, like it or not, there's going to be inflation coming up, okay, because of the low interest rate, because of all the cheap money that's been printed. Yes, inflation is coming for sure. I just don't know how they're going to handle that. Number three, they haven't got COVID-19 under control. I think most parts of Asia have got it under control. Most parts, not all. And in America, it doesn't appear to me that way. And I really don't know how they're going to do that. So it's going to be a hindrance when they need to reopen the economy somehow. And let's just see. Okay. So MDC, it appears at this stage, right, while it's a value play, there will be a lot of different, I would say, challenges here. So you have to be aware of these. So remember the question I've asked in the October special. Are you a trader? Are you an investor? Are you unsure? Okay. Trader, investor, or unsure? I don't need to remind you again what you need to do in each of these situations here. Always ask yourself the same question: trader, investor, or unsure? Unsure, don't need to do anything. Go and figure out your question first. Are you trader or investor? You're a trader, think whether you are trading. If you're an investor, think whether you're investing, right? Okay? Now, looking at it, I am looking at these trades on a budget put spreads. Okay, MDC for 18 June, standard expiry for 2021. There are the same trades, but I have two different approaches. Okay? Now we're looking at the first approach, which is pure trading, $500 per contract, and with a natural premium. That means we assume that the broker will actually allow us to fee a $1 credit. So the returns will be about 20%, annualized about 31%, with break-even price of $34. Okay? So this is one whereby we're going to get about 31% returns here. And as I look at it, right, if I go back here, you see that MDC's dividend current yield in a 5-year average is actually 12.5%. Okay, so I'm actually generating a pseudo dividend, a fake dividend, out of a company or at 31% if I hold a position until June without doing anything to it. Okay, if this trade goes well. Okay, alternatively, I am willing to own the stock all the way for $35, but I just buy a safety and I take $1 credit. So I will have 2.85% returns upfront. And if I to analyze this, this is 4.50%. So if the stock does go in the money, I will be considering to just take it outright and I'll have it in my portfolio because this is a company I really feel like I want to own it outright in my portfolio. And yes, this is the trades that I have in mind. So Terence, do you have any view for me?
Yes, I have.
Okay.
Okay, now, so maybe
let
you can
me send my caveat to the viewers here. The caveats to the viewers, okay? I just want your reassurance because I don't want to later I send these trades then, hey, Terence say, oh, no, don't want. This trade I also don't like because I haven't do this for a whole month. Okay, caveats here. Company has very high debt level, so you must be comfortable with the debt levels of the company. And if they don't follow the trend, this is going to be a potential value trap. Okay, if you don't like what you see until June, in the middle from now, October until June, you need to be able to cut loss, or if you're part of the IMP community, you know how to do the IMP repair, you need to activate the IMP repair. Okay, these 3 points I need you to take away first. All right, Terence, back to you.
Sure, no problem. How about before I go ahead, I think this question is pretty interesting. So if you can, maybe you tackle the problem.
Sure.
Uncle Fu is asking, what's the difference between MDC and KB Homes?
I don't have an opinion on KBH now. Let me take a look.
Okay, now, so while Jeremy takes a look, right, Uncle Fu, let me try to help you out. Okay, now, so this is how I analyze it before Jeremy does it, okay? Give me a minute. Okay, Uncle Fu, I'm just basically going through the earnings results on the charts for what I see. Okay, so if I look at KBH right now, KBH this year has earnings of about 55 cents earlier in June and about 83 cents in September, based on what it announced. Okay, but in June and September last year, it was announcing 51 cents and 73 cents. So there is an improvement, but there is not a lot of growth if we compare quarter to quarter. Okay, for KBH, what I'm showing you now is KBH. Yeah, okay, now, and then if I go back to MDC, which is what Jeremy has mentioned today, it just released its earnings, which is October, and then one earlier, which is in July. Okay, so if we just take a comparison, a like-for-like comparison, we have July last year, okay, where MDC announced 86 cents, and then for October last year, we announced 79 cents. So if you look at the purely on the earnings per share numbers, right, MDC seems to have improved a lot more if we compare them with KBH. So in terms of numbers that I'm seeing, I also need to put out a disclaimer. I'm not a hardcore fundamental like what Jeremy analyzes. But based on my simple analysis on just looking at earnings per share numbers over here, there seems to be a better earnings per share improvement and growth, okay, as compared to KBH, okay, as compared to KBH. Yeah, all right. Now, so Eric just brought out a question of why not DHI as well. Let's have a look as well. All right, DHI ain't that bad too. Okay, ain't that bad too. Okay, the last 2 quarters, 172 and 130. So that's April and July. So April and July, 93, 126. Okay, so I think MDC and DHI, which is DR Horton, is pretty much very comparable. Okay, but having said that, let me just go back to MDC and check out the prices.
I'm back, Terence.
Yeah, no problem. I think MDC and DHI, for my sense, in terms of my comparison, is very similar. But KBH seems to be lacking a little bit. Okay, let's see what Jeremy has to say.
Okay,
Jeremy.
Thank you, Uncle Fu. You have it right. I think they are very comparable here. But just on 2 points, I will prefer MDC. Right, but without those 2 points, I think they are almost the same here. KBH has a higher debt to equity ratio than MDC at close to 0.7. It's actually 0.69 as I see it. The PEG ratio is 0.4 compared to the MDC's 0.3. So we're actually paying about additional 33% for the future earnings compared to MDC, because 0.4 over 0.3. So if you, let's say, for example, I tell you that MDC is the company whereby I'm only not comfortable with it because there's high debt, but as long as they keep it under measure, it's going to be fine. Then if I put the same theory into KBH, then all the more I'll be uncomfortable. At the same time, if KBH pays, or rather, it's going to cost me more for the future earnings because of the PEG ratios being higher at 0.4 compared to MDC's 0.3, then reasonably, in terms of just rationalizing it, it doesn't make sense for me to compare between MDC and KBH and choose KBH. I should rather choose MDC. Right, so it's just a matter of putting them together and then just choosing it based on the preference of the two. Yeah. Right, Uncle Fu, if you have a response to that, do let us know. We like this part because it does help us sharpen our thought as well. Let's see. Let me try and see whether there's anything on KDHI. Right. Meantime, if you have any comments or any questions on the MDC, you can also let us know here. It is only through questioning that we get to improve each other and the decision more interactive.
So you're scanning the DHI, right?
I'm taking a quick look. Yes.
Okay. Okay, Jeremy, I think while you scan your DHI, let me go through what I see for MDC.
Sure.
All right. Right now, so for my take, so what I'm going to do is I'm going to change it down back to the daily charts first. So what you can see right now is MDC, sorry. Okay, MDC is on a clear current downtrend. Okay, so we obviously have the downtrend that's happening right now. Okay, and pretty amazingly, it's quite linear. Okay, it's quite linear where, you can literally draw a straight line where all the tops of the days are forming within the resistance line over here. Now, so what we also have right here is an indecision candle, which, we call it a doji, or, you can call it whatever you want. Okay, but this clearly signals indecision where the market opened here, okay, then it went all the way down, okay, but the buyer stepped in, it came back, all right, and the closing price happens to be almost the same as the opening. So this is where the bulls and the bears are fighting during the day, and they are they're undecided. They're undecided whether to sell it off or to start buying because it presents some value. Okay, now even the indicators have somewhat differing view. We have the RSI, which is flattening out. Okay, this is not hooking up yet. It's considered flattening out. Okay, so flattening out would mean that we may actually start to see this channel for a while. Okay, now then we have the stochastics, which seems like it's hooking up. Okay, but it is still below the oversold level. Okay, it's still below the oversold level. So it doesn't mean that it will also signal that it's a reversal yet. Okay, but clearly the MACD is down. Okay, and the histogram is gaining momentum, which means that the downtrend is still intact. Okay, and the other concern is this. The other concern is one of the MACD lines have already crossed the zero line, which means the primary trend may have seemed to convert to the downside as well. Okay, may have seemed to convert to the downside as well. So, these are a little bit of concerns while, you have some signs over here where it might be possible to go long. Okay, why do I say it might be possible to go long? Because let me take a longer time frame and put up some support levels. Okay, we do have some support levels that are clear and evident over here on the stock. Okay, so we have one over here. Okay, which is at about $38. Okay, we have another one over here which is at about almost close to $41. Okay, so these are two support levels that this stock currently has. Okay, now, so coupled with the fact that we have an indecision candle and sitting on, what I have over here, which is a regression line. Okay, so there is a cause to be expecting the selling to stop. Okay, either to stop or to start channeling sideways where we have consolidation. Okay, consolidation. And then the next part over here is, from my objective, I just see that the selling may start to pause, okay, but it may not signal that the stock will start charging up. Okay, why will it not start charging up? One, also because, like Jeremy said, we have political concerns. Okay, political concerns where, you know, if the ruling party starts to change, is there still going to be cheap money? Okay, because if there are no cheap money, then are there still going to be people wanting to buy homes? Because money isn't going to be too cheap anymore. Yeah, okay, all right. So these are immediate concerns, because if nobody are buying homes and home sales number starts to drop, all these housing stocks are going to plummet. Yeah, okay, so that is a valid concern, and it may seem to be pricing into the market. Those valid concerns seem to be pricing into the market. Why do I say that? Because if you look at MDC and then, you know, Uncle Fu mentioning KBH, can you see that they are all very similar? Even Eric, who mentions DHI, all right, they all made very similar moves. All right, which means that housing stocks have been selling off. Why? All right, not just earnings, because earnings have been pretty decent actually. Yeah, okay, so there must be some you know, concerns on the economy or the market as a whole. That's why they're taking some profits, or they're, you know, doing some corrective actions over here. All right, now, and I tell you something that is interesting that I saw as well. If you have joined us long enough, you will realize that I always say this: the shorter term trend always gives way to the longer term trend. So what you're seeing right now is on the daily, right? Okay, I'm going to take you now to the weekly. And on the weekly, you see a total different picture. Right? If you can see on the weekly right now, right, the downtrend has just started. Okay, why do I say the downtrend has just started? Because one, okay, let me change this up a little bit. Give me a minute, okay? Okay, all right, now, so this is a little bit bigger. So I say the downtrend has started because we had the same doji now, but the doji is at the top, all right? And then we had the turnaround candle, all right? And this week, okay, just this week, right, it broke this over here. It broke the low of the last positive candle. So that means that the bears have the control right now, okay? Now, coupled with the fact that we have the RSI that is going down now, all right, and the stochastics that is hooking below the overbought, we are just lacking. All right, we're just lacking this right now. The MACD, it has not turned negative. Okay, so the moment it turns negative, right, you have a confirmation of all four different signals, right, that is pointing towards the downside. So now, right, I have a contrary. I have a contrary where the longer term seems to be on the downside, but the shorter term seems to signal that the selling has been too intense. Right, and that led me to think of something out of the box. It led to think of me to think of a trade, a possible trade. Okay, because Jeremy was going to put out one, so I told him I'll think of something. Okay, but if I'm looking at this stock, okay, and if I want to execute a trade, this is what I will do. I will take both sides.
Oh.
Yeah, I will take both sides, and I will take them in consideration of their duration. That means I have a weekly chart right now, which is pointing towards a sell-off. Correct, Jeremy?
Yeah.
Okay, now, so I would be considering selling calls on the longer time frame. Okay, and then on the shorter time frame, just now on the daily charts, we have the signal that it's not going to reverse. Okay, but because we are not trading stocks, we are selling options. We always have the margin for error. So I can also add in a selling of the puts, but on a shorter duration. So this is what I have in mind. I have the idea of selling both calls and puts at the same time. So when I look at the option expiries and trade available, right, this is what I'm seeing. It doesn't have weekly options. So my only possibility is to sell a December call and then buy the sell the December call and then sell the November puts. Okay, so let's see how I'll design this. Okay, if I'm going to sell the puts, right, I want it to be based on somewhere close enough to this support level. Okay, that I've drawn, which is 40.8. Okay, which is 40.8. Now, so looking at it over here, a 40 strike is still pretty decent. It pays at least about $1. Okay, now I'm not going to talk about negotiation because you can see markets are closed. The bid ask is a little bit wide. So only when the market reopens on Monday, I'll be able to get the real idea of how the bid ask will look like. Okay, but if we are doing it based on what the platform is showing us, I may sell the 40. Okay, but I don't want it to be an unlimited risk trade because it's going to be too tricky in the market right now. So I want to cap my losses. So let's say maybe I'll turn around and buy the 38. Okay, so I'll convert this to a put spread. Okay, now if this is going to be a put spread, right, it may pay me something like 47. I'm not going to negotiate. I'm just going to take what the platform suggests now, okay, and then analyze it from there. Okay, now, so this will be the put spread that I'll be selling. Now, then on the longer term duration, okay, on the longer term duration, I will be selling the calls. Okay, now, so the calls now, it has a high of about 52.50. Okay, 52.50. Okay, but at the same time, we have this resistance right here, which is about 49. Okay, so I have to look at what strikes are available. So if I go to 18 December, okay, here's where I become restricted because it's either 50 or 55. Oops. Okay, all right, now, sorry, my share is go back on. Okay, now, so I either have to choose between 50 or 55. Now, but the 55 is obviously too low a premium, so it doesn't make any sense for me to sell it. So now I have to weigh out. I have to weigh out my risk and return kind of judgments over here. So if I want to do it, right, then I'll probably pair it up with a 50-55 over here. Because if the longer term change of trend is intact, right, technically it should not challenge 50 again, which is a nice whole number. Yeah, okay, it's a nice whole number over here. And based on the current price, it is at least about 12.5% above. Yeah, all right, 12.5% above from where the current stock price is. Okay, so I can add in the part where I can sell the 50, all right, and I can make it a limited risk by buying the 55. All right, now, so this entire combination would bring me about $1.07. Okay, it'll bring me about $1.07. So anytime I can close the entire combo for maybe half the premium, so I can pay 50 cents and get rid of all four positions, I may do it. Yeah, okay, but this is how I'll structure it. That means what I'm basically foreseeing is the fact that I foresee that this stock will consolidate. That means it will neither go up, it will neither go down. It will consolidate within a range for a while. So while it consolidates in a range for a while, right, we will get the time premium decay for both the calls as well as the puts. Okay, but just in case it sells off, okay, just in case it sells off, the puts over here will be in trouble. But the puts over here only has a maximum loss of $2. Okay, so $2 where I'm collecting $1.10 upfront, right? That means my loss is only 90 cents. Okay, it's less than half of what I'm collecting. Or it's almost 1:1. Okay, it's almost 1:1. Yeah, okay, so if I'm looking for a trade, this is how I'll design it. Okay, now, how much would I need to put up? Okay, how much would I need to put up in terms of margins for the trade? Because this is a selling trade, right? Now, for the call side, for the call spread, the broker will probably ask you to put out about $5, which is the maximum loss. Okay, and then on the put side, they will ask for about $2. Okay, so you're looking at about $7 over here for this trade. Now, some of you will be asking, Terence, why do they demand both sides? Because technically the stock cannot be both sides at the same time. You're right, but the problem is both these sets of options have different expiry dates. Okay, the puts expire in November while the calls expire in December. So that's why their risk profile is technically different because their expiry dates are different. Okay, so my consideration, I believe they'll take slightly less than both sets of maximum loss. Yeah, okay, but I'm just going to allocate at least that amount. Okay, so the potential ROI on this trade then is going to work out to about 1:7. All right, that's pretty much how it's going to be. Yeah, okay, now, so if I take 1 divided by 7, right, that's about a 14% return. Okay, a 14% return trade over here, which lasts a maximum of 1.5 months, which is 47 days. 7 weeks. Yeah, about 7 weeks. Okay, if I happen to close the trade any earlier, right, it might bring up a better than expected annualized ROI rate because a shorter duration on the trade itself. Yeah, okay, now, but this is how I look at it. Now, for those of you who asked me on, who actually brought up the point about DHI and KB Homes, if I'm structuring a trade, I'll probably do the same thing. Okay, why would I say I probably do the same thing? Because remember just now on the daily charts, they all look alike. Let me show you the weekly charts now. They all look alike. Right? Ironically, they all look alike. Right? So this is KBH and then this is DHI. Yeah, all right. So on the longer term trend, it all looks like it's reversed. Yeah, all right. DHI, you can even consider maybe this as a double top. Right? This was a double top plus a divergence on the RSI. right? Plus a divergence on the stochastics. Yeah, all right. So yes, it does seem like I am more concerned on the downside rather than the upside. Okay, but if I have to pull back the dailies, okay, DHI doesn't have the dojis. Okay, doesn't have the doji, so it may not seem like consolidated yet as well. Yeah. Okay, now, so this is just my differing view over here and how I'll trade it if I were looking at this stock and trying to hunt down a trade. All right, Jeremy, back to you, man.
Okay, I have a response to the question on the DHI, whether DHI is better than MDC here. Okay, let me just try and share my screen. I'll remove yours, Terence.
Yes, please.
I think it's not showing right. Give me a second, yeah.
Can try it again. I stopped my screen share.
Yep. Okay, you're saying this. Okay, so this is the Weekly Wall Street Executive Summary for DHI. And as you can see, the V's that they have highlighted here is actually significant insider selling. And as we look at it, we're looking close to 2 million value. I did a summation earlier. It's got close to 2 million, I'm not wrong. But it's pretty negligible, less than that actually. So if you look at it, right, total value of the stock, the amount of insider seller is, I think that was a sweat stain compared to what NBC had. Okay, but then the question is, compared to MDC, which is better, right? Now there's one metrics that actually is the deal breaker to me. Now I need you to reason out like this, okay? Enrique as well as Uncle Fu has his opinion on this. Now between MDC and between this is DHI. Now let's just say that between MDC and DHI, we are comfortable with their numbers altogether, and they are okay all the way, right? So now we are looking out for a difference to see between the two of them, which to pick, right? And we just need to know which do we want to. So to me, I will come to this PEG ratio. Think about it this way. MDC has a PEG ratio of 0.3, meaning to say for every dollar you put in the stock here, you are actually buying into a 0.3 or like the $3 multiplier of the future returns. Whereas for DHI at a PEG of 1, it means to say what you're buying now is equivalent to a future earnings of what you get based on the theory of PEG ratio. Again, what you're buying now is based on the value of the future earnings that you're getting. That means to say there is no value in terms of the future earnings perspective. Whereas for MDC at PEG ratio of less than 1, you're still getting some value. Number one. This is number one that you're seeing. Okay? So from the PEG ratio perspective, MDC has an edge of 0.7. So every dollar you put in, the same dollar you put in for MDC, you are getting additional 70% of future earnings. That's the first question. Okay. Now let's compare stock prices. Okay? Let's just use this. Currently, DHI is trading at $66. MDC is significantly lower. So just based on that, we know that MDC has certain level of things that some of these parameters that we're not comfortable with. But the fact that MDC has some edge in terms of future earnings that we can buy into at a lower than $1 price now, lower than 100% now, and the stock prices of MDC being lower than the KBH that we're looking at, it does give us some perspective that we can refer the MDC in a certain sense here. I'm not trying to say that, okay, hey, it's a case of I'm right, you're wrong, or you're right, I'm wrong here. No. But in terms of how I'm looking at this is, I'm looking out for value. The whole point of doing fundamental analysis is looking out for value. Otherwise, there's no point for me to do that. And if I'm looking out for value, there will always be an exchange here, something I have to trade for. That I will have to accept certain level of damage in the company's numbers in exchange for something that I can get for a future return at a discount. And for that same reason, right, MDC fulfills that purpose, but KBH doesn't, just for myself. I mean, I'm thinking whether Enrique understand what I'm trying to say. Yeah. Yes. I get what you mean here. So just purely PEG is subjective here. So if let's say, for example, purely looking at the fundamental numbers here, the DHI numbers are better, absolutely better. Nothing wrong about that. Yeah, but for me, I would prefer to have a potential edge such that if let's say, for example, this edge allows my portfolio to have a explosive return in the long run, or I can pick up the stock and then allow it to ride out the bad years and then pick it up eventually in the long run, then this is a point where I pick up a great stock at a discount point. But DHI don't allow me to do that at this moment. So I'm not looking at that because of that. So it's got to do with the difference in terms of why are we doing that. Like maybe for example, Enrique, I'm just trying to reason out. Okay, maybe for Enrique, you're looking at more in terms of, okay, I just want the options to expire. So I'm picking the companies that is more better and robust in terms of its numbers. Nothing wrong. But for me, I'm looking out for more range of plays that I can play. I want the numbers to be good, not too bad. I want potential plays in terms of I pick up the stock and then I can do maybe cover costs in the long run. I can pick up the stock and then I can leave it in my portfolio to collect dividends in the long run, that kind of thing. So because of my considerations, then I would prefer NBC. This is just my train of thought. Yeah. Right. Uncle Fu, do you have a comment on that? I would love to hear your comments. Or any of our viewers here, do you have any questions you would like to ask us? We just
okay, while we wait for the questions over here, I'd just like to inform, because every session there are always going to be new ones, okay, new incomers who are joining us. So if you're not familiar with the different options, trades or strategies that we have talked about earlier, as you can see, scroll on the bottom right now, you can head over to our website, www.impossibleinvestors.com. Just opt yourself into Project Options Cash Flow, and you will be receiving a free, all right, it's totally free 30 days video guide, video course from us, okay, and it will equip you for not only more about options, but also understanding the topics that we are discussing for today's session, as well as my weekly Fridays segment as well. All right, Jeremy, let's see if we have anyone new.
All right. Yes. Anyway, Enrique, I like your question because it does helps to bring out the perspective that hey, you have a train of thought in terms of what you're doing, and because of your considerations, right? You're very clear that okay, for yourself, DHN numbers are better, and this is what we want to do when we actually started the stock Nit-Picking sessions with Terence and myself here. We want to sharpen the train of thought such that it's not always going to be Terence and myself sharing, but rather we sharpen the reasoning process behind the community, and then as a whole, we can improve the community collectively. And it's not going to be always us one direction, me sharing ourselves here, because everybody's perspective is going to be different here. So there will come a day whereby what we share will not be something you will find that is relevant to you, because ultimately, how we consider things will be different. Like myself and Terence here, even between us, right, him being my mentor here, sometimes the trades he issue and the trades I consider, we don't agree with each other. But we discuss and we try and find a discussion whereby we try and cover more grounds and look out for each other's blind spot. I think that's the more important part we were trying to achieve here. Yeah.
Okay.
FNMB? Sorry, you're referring to a company, Enrique?
Yeah, I think he was trying to suggest a company.
Let me just have a look. See, what is that company?
The bank, I think. Farmers National.
Okay, this is what I'm gonna do, man, Enrique. I don't have any plans to actually do that company for time being, but I will keep a lookout. If let's say it does comes out in my screeners and it fits my criteria, I'll give it priority to see if I can do a review on that. Yeah. All right. You're saying that it's a hidden gem. Yeah. I'm doing a shout out here. Would you like to maybe share and see if you would be open to do a sharing with us? We did mention this sometime in September that we are actually open to have our community members do sharing as well. So if you do find that it is a hidden gem, you can also do a sharing. And I think there's no shame in doing that. Even if, let's say, for example, not everybody agrees with you. Oh no, that's no. Okay. I
Okay,
shall put you on the
maybe what we can do, is this, Jeremy. How about? No worries, Eric. How about maybe we can dedicate a quick 5 minutes in our next week segment or our next segment that we're doing to providing some analysis, because I think it'll be fair also for Jeremy to have a deeper look before he gives comments on this company.
Yep.
Yeah. Okay. So I will see if Jeremy is fine with that. If he's fine with that, then in our next segment that we'll be doing, in our next chapter that we'll be doing, I'll get him to do a quick 5 minute sharing as well. Okay, on just this company. So it won't feature as one of our main selection, but he'll just bring it out in terms of anything that he sees that are of concerns or anything that he sees that are supporting your idea of a hidden gem over here. Yeah, I think Jeremy will be more than happy to do that.
Actually, I would love to have a one-to-one discussion with you to see why do you think there's a hidden gem. So maybe you can just reach out to me privately, and then let's have a discussion offline, and in terms of like just having it privately. Yeah.
All right. Just get in touch with him, because Eric, you're in our community anyway. Get in touch with Jeremy, and then maybe both you guys can work out the fundamental aspects.
Yep. I can be your mouthpiece.
All right, Jeremy, do you have anything else to add on?
No, I don't have anything else to add on. I'm just wondering whether our viewers have any other questions that they'd like to ask. Okay,
sure. Now, so if you don't have anything to add on, I just want to do a brief mention before we go towards the closing. So we have gathered some emails, as the team has mentioned to me. They will be replying all of you once we, over the weekend, once the weekend is over. Okay, so if there are any of you who are still looking to jump on board, okay, and build a portfolio based on option selling, okay, we have a December intake upcoming for our new online mentorship programs. Okay, so do send us an email, okay, if you want to find out more about the structure and how you can jump on board. Okay, so if you like the discussions of our weekly segment so far, okay, and you want to find out how you can execute some of the same strategies and make money in a certain way with much lower capital requirements than what I've done in portfolio building segments, or understand some of the trades that Jeremy and myself has mentioned during this weekend segment as well, then consider jumping on board the mentorship and gather more details about how you can be a great option seller. Yeah. All right. Now, so yeah, I think Eric says he's fine. Okay, so he'll probably get in touch with you soon, Jeremy.
Yeah, drop me a private message on Facebook.
Okay, all right. Any closing, Jeremy, from your side?
Yes, there is. This week is going to be something that is very crucial here, so I just want to launch some reminders here. So we're going to have the binary event that happens every 4 to 5 years, and this is the presidential election for US here. And the last time it happened, it was a very big hoo-ha in terms of like unexpected events here. Market actually went up in the last time round, if I'm not wrong. So I've been going on a cold turkey in terms of my own portfolio. I only took one trade the whole week, and it's a very, very tight trade that I chose. So I just want to remind our viewers here that there will be a lot of values plays this week. There will be a lot of value plays this week. Don't overexpose your portfolio now. Don't overexpose your portfolio now. We know that the economy for US is going to be facing a lot of different issues in the coming 2-3 years. So if you're going to be spending more time to do your own, fixing your problems now, I don't know the word other than the curse word, right? So you're going to be missing out a lot of opportunities in the long run. So be patient and wait. If you really want to be trigger happy, make sure you take a defined loss position and keep it really, really tight and keep it really, really safe. All right. Yeah, I think that's the only reminder I like to just share.
Yes, I do agree with you. Elections are coming, so there are going to be some of you who are trading on volatility. So if you are and you know what you're doing, by all means, go ahead. Yeah, okay. But what Jeremy is saying is, if you are, a longer term or more passive investor, and you're thinking about what stocks you can go long on in the market right now, be it selling put options or be it buying the stocks or any strategies that does so, you don't want to take on a heavy position going into a binary event. Yeah, okay, because just citing the last elections, all right, we are probably going to see the same thing happen, right? Because the results, as as much as it seems like it's favoring Biden right now, it is pretty similar to the last outcome. Right? Nobody knows what kind of foul play is going to happen at the day before. You know what I mean, right? Yeah, right. It's 3 more days, so that seems like a trick in his bag. He likes to wait for the very last moment. All right, and it's still 3 more days, so the tide can still turn for Trump itself. So I have no idea.
If it helps, right, just remember that the stock market now in US and the actual business condition, the climate in US now is very different already. Yes. One is in the height, one is at the bottom. So this Biden event doesn't help it.
You must really understand the concerns over here, because the market is only kept so high because of cheap money. So if there are any government changes that signals towards that the cheap money may not happen anymore, or it may not be as strong as what they're doing right now, that means a slower pace, a lesser payout, or whatever, right? It's going to swing the market. It's going to swing the market because corporates, technically they're not recovering, except all those that deal with internets. But even those that have, enjoyed the boom, right? Many of them are showing signs of slowing down. Yeah. Okay. So it doesn't bode well for the economy. So unless the cheap money continues, unless they continue printing more and more and promise people more, all right, the party may end. Yeah. Okay. And when the party ends, you don't want to be left holding the bag. Yeah. Okay. So beware. Hedge your positions. If you need to do anything you need to do. If you feel that, if you really feel this, just as a party shot suggestion before we end, if you do feel that, Terence, I'm really stuck right now because I have so much long exposures and it's already too late for me to get out, I'm sitting on losses on some of them. Yeah, okay, I don't want to let them go. Okay, now what you may consider doing is buying a put. Yeah, okay, buying a put not on the stock, but buying a put on the entire index. Okay, and what you want to consider is you need to think of something expensive. Okay, all of them right now, it's going to be expensive because after the sell-off that has happened. So the only way you can get something that's decently priced, okay, is to go out there in the market and buy a heavy delta put option. Okay, all right, heavy, yeah, really heavy delta put option, especially just for this week itself. Okay, because this week itself is the, is the binary event. Okay, just as a parting shot. After this, we'll call it to a close. Okay, Jeremy?
Yeah, all right.
Okay, now, so, for example, 6th November, all right, 6th November, what you may consider doing is going out there, all right, and buying, this almost 80 delta kind of put options, like a 340 put on the SPY. Okay, a 340 put on the SPY. Now, what it does is it costs about $14.50 based on the last traded price. So you're going to spend about $1,400, all right, to buy a hedge. Okay, for one option contract, it's going to cost $1,400 to buy a hedge. Okay, but what's going to happen is if the market collapse, okay, if the market collapse, okay, this is going to protect you. Okay, this is going to protect you because you're going to get almost every dollar on the downside protected. Okay, based on the index, because if it cracks 320, you may see 3,000. So 3,000 on the SPY will mean 300. If you have a 340 put, okay, by the end of the week, if we really reach 300, this put option will be worth $40. Okay, you paid $14.50 for it. It's worth $40 by Friday. All right, you're gonna still pocket a $25 profit out of it. Yeah. Okay. What if you're wrong? What if you're wrong? Yeah, maybe we see a spike up. We see a spike back to 330, 335. Okay, this put option will still be worth something like $5. Then you can cut your losses. Yeah. Okay. So you just have to decide: am I comfortable with the binary event? What if it collapses? If it collapses based on all my current stock positions or long positions, am I comfortable with another 5% drop? Okay, and how much losses it will be on my portfolio? Or is it more sizable to spend $1,400 to buy a put option just for this week itself? That's an idea. Okay, that's just an idea. If you say, Terence, but that's really too expensive, then you just play around with it. Everyone, play around with it. If you are part of our community, you may consider doing this. All right, turn it into a put spread. Buy a put spread. Yeah, okay, decide how much you want to protect. Okay, how much you want to protect, make that as your maximum profit, and then make it a put spread, something like that. Okay, all right, I'm done, Jeremy. I'm done.
All right, we are done. And we want to collect back our Sundays, the rest of it.
Yes, we want to hand all of you back your Sundays as well. Of course, you know, it's always a valuable time. So thank you very much once again for joining us on this weekly segment. We really do hope that you enjoy and you benefit from these segments as well. So if you did take away something today, there was something valuable for you to take away, could you leave a comment and let Jeremy know about this? Yeah, okay, that, you know, he is getting to the point whereby many of you are learning something. If you feel that there is something he could add on in terms of the fundamental content and angle of analysis, right, do make a suggestion as well in your comments. Yeah, okay, we do take things positively over here because it is done for you, right? That means if there are things that we can improve, we will be more than happy to do so. Yeah, okay, all right. Now, so that's what I have for today over here. Jeremy, anything before we go?
No, I just want to thank everybody for investing your time in this session with us as well. It would not have happened without everyone as well. I mean, I can't be talking to myself.
All right, great. Thank you very much. And for those who are part of our community, remember tomorrow, Monday night, is always live trading night. So I'll see all of you at the live trading webinar, which is done now every weekly on Mondays. Okay, so bye-bye, everyone. Okay, we'll see you next week's public segment or tomorrow's live trading for community members. Bye-bye.
Bye. Enjoy your weekends.
Yep. All right, you too, man, Jeremy. Bye-bye.
All right. See you, Terence.